Hit it.
It's Friday, February 18th, 2022, episode 169. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we welcome option guru Kris Sidial, co-CIO of Ambrus Group. We have a terrific discussion on how the market microstructure has changed the opportunity and volatility strategies. And make sure you stick around to hear his prediction about where the stock market might be headed this summer. Then Patrick once again demands to be taken seriously with this technical analysis. But as usual, the alliances please fall on deaf ears.
And then we end with our segments of No Stupid Questions and Skin in the Game. And folks, we might even drink some beers along the way. Stick around. We got a great show. Lena, hop on. What beer am I drinking today?
So today, Patrick is drinking El Capitan Double Dry Hop New England IPA.
This is right from. I'm right now in Lisbon, Portugal, and trying some of the local craft beers. And this is a delicious little New England IPA.
So the New Englanders got transported to Portugal?
Yes, they did. Yes, they did.
I had to translate the Portuguese into English, so here it is.
All right, go for it.
El Capitan is a wall of hops that you will enjoy climbing. Cloudy and orange beer with double dry hops, leaving aromas of mango, tangerine, and pineapple. Sounds nice and fruity.
Yeah, it's actually it's really nice.
Oh, is this El Capitan like after Yosemite? Is that?
Yeah, I guess so.
I'm assuming.
Yeah.
Anyways, it could be a poor translation. I'm not sure.
Yeah. Anyway, Lena, do we have a plug for the merch store?
Always. Please go visit our merch store at markethuddlemerch.com and get yourself a nice pint with Market Huddle logo on it to fill that glass with cold beer that you'll be drinking while you listen to the show.
Lena, do we have stats in terms of which of the products is the best selling?
Not yours.
Makes sense, but I do demand to be taken seriously.
Good luck with that. All right. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include the hot potato portfolios, baby boomer bond vigilantes, or the Bullard burps.
Nice.
A lot of bees in there.
Let's get to the interview.
It's our pleasure to welcome to the show Kris Sidial from the Ambrus Group. He is the co-CIO of one of the most up-and-coming vol firms that I know out there. He's a real force on Twitter. He's a great guy, and I've been looking forward to this for a long time. Thanks for being on the show today, Kris.
Hey, thank you for having me. I really appreciate it.
So, one of the things is usually when we talk to these grizzled vol traders, they all seem to, if they don't look like Nassim Taleb, they have the same kind of pedigree, and their length that they've been around has been much longer than you have been. You are a fairly young guy. How did you get into this business? Let's go through your history if we could.
Yeah, so I think my background was very different than, a lot of traditional finance guys. I'm actually currently completing my master's at the University of Pennsylvania, but prior to that, I actually came from a non-target school. So kind of breaking into Wall Street from a non-target school, it was definitely an uphill battle.
Okay, so wait, Kris, I didn't mean to interrupt, but what does a non-target school mean? I don't even know what that. I've never heard that term before.
Yeah, so it's kind of a thing in the States, right? In the U.S., it's like you have target schools where a lot of kids are recruited from, right? So you have the standard Ivy Leagues, like UPenn is one of them, right? You have Harvard, and obviously, schools like that, very prestigious schools that are known for producing, high level finance kids. But then you have other institutions that are not really that well known for that, which doesn't necessarily mean they're, a bad program, bad school, but it's kind of like a little bit of like a Wall Street stigma in a way. And I think, coming from one of those non-target schools, it's really hard for kids to try to break into Wall Street because it's a certain pedigree that they look for. So for me, it was definitely an uphill battle, a lot of sending out resumes, trying to really network. I know I've told a bunch of stories about that, my past and going up to people and trying to get my name out there. But the first shot that I had was with a gentleman named Bob Cantor. He was actually one of the individual guys that started the CBOE. And Bob kind of took me under his wing as his junior trader, right? So he was like the first real whiff of vol trading that I got was from Bob. And, he's a very experienced guy, obviously, like one of those veterans, that everybody would.
The grizzled veteran. He was been around forever. Now, like, can I ask first of all what school you went to, and then did you move to? Is it Chicago or New York? Like, how did your life evolve from that perspective?
No, so I went to LIU, and I lived in New York my entire life.
Okay.
Yeah, so I was born and raised here, and still live here to this day. But yeah, that's kind of how I came across Bob. Because he had a place in the Hamptons, and he had an ad that was out on Indeed, and I kind of picked up the phone, called him, went through a couple of his interviews, and next thing you know, I was his junior trader working for him at his family office.
Really? Now, did he have an office in the Hamptons? Did you have to do the reverse commute?
Yeah, exactly. I had to, yeah, it was one of those things. So he had a home office, and then he had an office in the Hamptons, which is pretty cool too. So yeah, I had to do that commute, driving all the way out to the Hamptons every day. But I learned a ton from him. I learned a great amount from him, and I think he shaped the way how he really molded me into what I would like to think as, a good trader. He drilled that old school Chicago pit style of trading in my head, along with the esoteric type of complexities that come with being a vol trader. And then, I learned a lot from Bob, and then I went to Chimera Securities, which is a prop trading firm. I was on the prop desk there for a little bit, and really getting a good understanding of trading order flow and how markets function, how some of the games as traders take place, market maker games and things of that sort. Then from there, I went to Xanthus Capital Management, which is a small buy-side equity hedge fund, but was very prop focused as well, in the way how they look to trade things. And then, prior to starting Ambrus, my most recent role was at BMO Capital Markets. I was on the exotic derivatives and listed options trading desk there. I spent about 3.5 years at BMO, and most of my time was spent on the exotics desk. And I
didn't realize that you had a little time at a Canadian bank. Seems like everyone has to put in their time at a Canadian bank.
Yeah.
Wait, that's in New York City, though, right? You didn't come to Toronto, did you?
I did go to Toronto for kind of just like just being a part of Canadian Bank. They want you part of the culture a little bit. So I did spend a little bit of time in Toronto, not too long.
How long were you here?
Like a month.
You were a couple months. Okay. Did they make you come in January?
No, thank God. I can't. No, they made me come in the summer, man. Yeah, I was there in the summer. Thank God, because I was just like, Toronto's a beautiful place, nice and clean. Like, I really enjoyed it. I enjoyed my time there.
We just got rated actually the most multicultural city in the world for the fifth year running.
Nice.
Yeah. So anyway, so you're BMO, and then you decide that's it. You've had enough of us Canadians, and you're going to go do something else.
Yeah. So throughout my time at BMO, I learned a ton from a lot of the senior traders on the desk, and really the complexities in managing a $1.5 billion exotics book, or looking at a $1.5 billion exotics book and thinking about how to really structure things that, one, can protect the bank, and two, generate some sort of alpha. And throughout my time there, I learned a great amount of focus on risk and being able to sidestep risk and things that I think you would not learn unless you were part of an institution like that. So I'm truly grateful for my time there. But I think one thing that I did see too was the changing market microstructure that was transpiring in the U.S. equity space, specifically the change that was being driven by the derivatives market. And I think, my current partners right now, you meet guys in the business that you become friends with. You understand they're good traders as well, and you think very like-minded. Yeah, I really gravitated over towards them. We all collectively kind of came together. And, after COVID hit, prior to COVID hitting, I think we kind of all had this same view. And, the firm wasn't founded at that time, but the partners themselves were running, a strategy that had the same sort of view as to, how we collectively thought. And, they absolutely crushed it. And when COVID came and, they made a good amount of money on that, I looked at it, and once the market rebounded, I said, hey, the market microstructure has not changed. We're going to see these whipsaw type of moves much more often than we're used to seeing because of this reflexive dynamic. And, from that, I think, I gave it a couple months to talk it over with, my family, and, talk it over with the partners and see if this is the move that everybody wanted to make. And, I think I left BMO and we all came together and we started the firm after.
It sounds like this idea that the market microstructure has changed is fundamental to your strategy and what you believe. Can you walk us through what it is and what you noticed?
So I think there is so many different things that kind of lead into the same thing. Like, it's all saying the same thing. And I think one of the biggest things was how the growth of the derivative exposure is leading to this dealer gamma hedging component, right? So what you're seeing is there's 3 times the amount of short dated options that are being traded in today's market than there were in 2020. And what it leads to is the fact that a lot of dealers need to hedge their book and, in a fashion where they're actually going out into the open market and pulling liquidity, right? So that is one of the dynamics that drives market prices lower when things go risk off, or, drives market prices higher, when things are kind of risk on. So it aids to this reflexivity that transpires in the markets that kind of underprices the reality of tail events. And when you factor that in with the fact that, a lot of this market has leaned towards passive investing, the growth of passive investing is tremendous, right? Systematic passive investing, and a lot of mandate investing as well, right? So it's almost like everybody in the room is taking the same type of trade, right? And it's creating this additive part of the reflexivity. Then when you think about how people look to act, right, in moments of market stress, they're all acting in the same manner, where it's like, volatility goes up high enough and markets go down low enough, and then everybody wants to exit at the same time. When you think about all the long short funds that are out there, all the long equity funds that are out there, when you think about all the short volatility funds that are out there, it's almost the same thing, right? Same trigger. Like, okay, VIX gets over a certain point, we want to exit. A lot of quant strategies that are being ran, right? Like, under the hood, it boils down to the same thing. So what you end up having is, like, when things hit the fan, everybody looks to deleverage at the same time, and then it's like it creates these big cascading effects from this very massively lean one-sided positioning. And I think
Sorry, 1 second, Chris. Just so you know, you can't say shit here.
Oh, okay. I apologize.
Maybe you're just too nice a guy and you don't say it, but just so you know, you are allowed to swear. Okay, I didn't mean to get you off your train of thought. Keep going.
all good, man. Yeah, when things hit the fan, it's one of those things that people just looks to deleverage right at the same time, and it just adds to this like big cascading effect. And what to kind of plug somebody in here, Corey Hofstein from Newfound Research, I thought he wrote an amazing paper on his take on the liquidity cascades, because he kind of he kind of circled all these things into one factor, right? And that I didn't even get into the big thing. And one of the biggest factors for us is the fact that when you think about the way how derivatives operate in the US equity market, it's all being controlled by about 4 main market makers, right? Like, it's no surprise to anybody that trades these derivatives that understands under the hood that it's really being controlled by 4 main market makers. And the way how they look to act during moments of market stress is they actually go into the open markets and pull liquidity. right? Because everybody is trying to protect their book in the same manner. So, the job of a market maker is to be out there adding liquidity, but it's not the same way how we seen years ago, right? It's like we're going to add liquidity until, things get a little bit bumpy, and then we're just like, yeah, every man for himself. Like we're pulling our offers, we're pulling our bids. We're out of here. And because technology has advanced, right? There's so much electronic trading that's obviously extremely advanced. People are able to do this, institutions are able to do this in a really fast manner. And I think, COVID is one of those things, like March of 2020, where we've seen how extreme it could get. And these factors have only gotten worse since that time, right? The control of the market makers have only gotten worse. There's more and more options are being traded, more systematic programs are out there, right? Like people say that a lot of short volatility exposure is no longer in the market anymore. Well, that's not true. The risk has been transferred into other buckets of the market. And I think this leads into how we view the world is like, hey, if you can position yourself for these extremely large payouts and not bleed away, tremendously like your standard tail risk fund or, long volatility fund, is just kind of just hemorrhaging money away. If you could run a book that is, has a slight negative drag or, a little bit close to flat or something, but keep that exposure on the book that could offer a tremendous payout, you're bound to run into these events because the probability of these events occurring is significantly higher in this environment.
Okay, there's so much there I want to unpack. Let's start with the four main market makers. I can guess some of them. Like I'm assuming if you're talking about in the option square, JP Morgan's got to be one. Citadel. If I got those two right.
So believe it or not, JP is a powerhouse. Shout out to the guys at JP Morgan because I actually know a few guys on the derivatives desk. So
yeah.
But it's really it boils down to Citadel, Susquehanna, Wolverine, Jane Street. Like those are the main ones that are extremely competitive and kind of dominate the space.
Okay.
More so, from an electronic standpoint.
Right. But I have a question in terms of like everyone knows that option whale, the JP Morgan hedge fund client that rolls at the end of every quarter, right? And it's kind of open secret. Everyone knows about it. You always see the big print, and the big print is always, let's say they're doing 40,000 contracts. There's always a 20 and then a whole bunch of twos. And I'm assuming that the 20 print is JP Morgan themselves on the other side of it. So the point is that on that trade, there's a bunch of guys or a bunch of firms taking the other side, and they're dividing up the risk. But on a day-to-day basis, you're saying that the Citadels, the Susquehannas, they're making markets just out there in the open more. So on kind of ongoing market making, those are the real powerhouses.
Yeah, the inventory that they have in their books, right? Their ability to be ultra competitive, their ability to kind of control the NBBO, right? They're just this is what they do, right? And it boils down to the fact that when people think about true liquidity and they think about diverse liquidity, right? And then you think about the driver, because there's no surprise to anybody now in this market, at least, that the derivative is literally leading the underlying, right?
That's right. Like it's actually more liquid than the underlying. It's almost like bonds, cash bonds versus futures. Futures are the real market. And increasingly, you could almost argue that options are becoming the real market on some of the underlying kind of S&Ps or whatever stocks. Tesla, for example. Tesla might trade more. Does it trade more options than stock?
Yeah, I think there was a stat on that a couple of months ago that the notional was actually higher. I got to go back and look at that. But yeah, I think there's factors that are like that are transpiring, and then you look at it and you say to yourself, well, okay, so if the option is controlling the underlying equity, and then only 4 institutions are really controlling the options, right? Then like what's really going on underneath the hood? And I think we have a false sense of security that this market is like healthy. And I mean, man, I feel like I've said this on like every podcast now, but as a vol guy, I definitely want to emphasize that we're not perma bears, right? Because I think people get so caught up into our thesis, and they get so caught up into, how we view the world and how we view, taking very sophisticated mathematical bets with positive EV. And they think that we're just like, hey, we're betting on the market to fall. We want the market to fall. But that's not the truth behind it, right? We're pretty much saying that like the chances of these events occurring because of this like deteriorating market microstructure, it becomes significantly higher in this regime, right? Like, I know you had a thought there. I just wanted to kind of shoot this one out there real fast for people to kind of have an understanding. Like, when they think about the crash of the '80s, right? The crash of 1987, a lot of people forget that, like, it was Shoals that got blamed for, Shoals at LTCM, right? The like Black Scholes, the derivative pricing model. People forget that like he partially got blamed for the crash because people were saying that, well, you were pretty much preaching that people should dynamically hedge, right? And what does that mean, right? Like if you read the book, right, When Genius Fails, and the story about LTCM, it literally goes back into talking about how like, he was kind of telling people, you should dynamically hedge. And then when people were looking at the crash of '87, they were saying like, you know, a lot of people were quote unquote dynamically hedging, and that just drove asset prices lower. And we fast forward, right? Like, decades later, and we're kind of faced with the same problem, but in a much more balloon fashion, right? So I think there are factors like this that people have to understand when they think about the structural implications under the hood, and not just looking at the fact that, okay, the S&P is at 4,500, 4,700. That means things are great.
So for those who don't kind of aren't familiar with the dynamically hedging, what that was basically clients, instead of them buying the option, they would actually do the program, the hedging that market makers would eventually do when they sold the options. And that was created, in essence, negative gamma in the market, even though there wasn't as much options. One of the comments that you made, Kris, was you said risk is transferred into other buckets. I would love to kind of understand where you think the risk has gone. Is it those four market makers that we just talked about?
Yeah, I think there's like a risk that comes into like a clustering effect, right? So when you think about like true diversification, it comes when you have market participants that are doing things for a completely different manner, right? So, you don't want, if you have a stock, right, and you think about the demographics of the participants that are holding the stock, it's never healthy when everybody who's holding the stock has the same goal and is looking to act in the same manner, right? So think about it like this. Imagine if you had five large institutions that were all holding one stock, right? No other holders. And they all had a mandate to sell when the stock went down 10%. Well, then you would tell me, Kris, well, when the stock goes down 10%, everybody's going to sell. But it becomes different, right? You get true diversification when you have, hey, I have a couple family offices that want to hold for, 5-year term. You have, retail investors that are in there, right? Like when there's different goals and there's like different holders in the equity itself or in the asset, it becomes different because not everybody's looking to act in the same capacity. But when you have, the market makers that are all acting in the same capacity and are looking to, kind of accomplish the same thing, and they're kind of controlling the same thing, it's almost like this clustering and hoarding effect where all the risk is kind of there. And, that doesn't even, we don't even talk about the large market makers like the banks, right? Post Dodd-Frank, the banks are no longer able to inventory the same amount of risk that they was. And, it's just a way of me saying that the banks need to make sure that they hedge their exposure more actively. Whereas prior in the, the early 2000s, 90s, 80s or whatnot, the banks didn't have to actively hedge their book, right? But now, because of the regulations that have taken place, banks need to hedge more frequently. And what that means is that it's the same liquidity pooling process, right? Because if a bank is short gamma and their exposure is kind of blowing out, well, the compliance officer, risk officer, whatever you want to constitute them as, would come in and say, hey, you have to make sure that your Greek exposure is at this number by the end of the day, which means you better go out and sell more stock or buy more stock or whatever. And that adds to this reflexivity dynamic. So I just think that the way how the risk is being transferred in other places, it's this like cluster effect where you have more people that are looking to do the same thing in the same manner. From a short vol standpoint, I know a lot of people talk about the short variance. Variance swap sellers are out of the market because of COVID. But the truth is, a lot of that risk got transferred over into the structured products area in terms of like, banks running with like Phoenix auto callables and levered buffer notes and barrier notes and things of that sort. The U.S. structured products market has trumped Asia. Last year it actually surpassed Asia, which was the largest structured products market that was out there. So it's like, the variance swap sellers, the people who are yield hungry, they didn't completely go out of the market. Sure, they got blown up, but they just found other ways to come in and systematically generate yield, that's really the problem, right? It's whenever you have something that is extremely one-sided, that is done in a systematic way, that's where it could be a hazard to the overall health of the market.
Okay, so I didn't realize this, that the structured products has grown significantly in the last couple of years in the U.S. Why don't you explain to people what that is and why it might be a concern?
Yeah, so when you think about where rates are right now, right, over the last few years in this low interest rate environment, if you are an advisor or if you have private wealth clients, you are thinking about different ways to generate yield for clients. So the structured products market has opened that up because it gives clients a different way to generate 12, 13% a year.
And how would they do that? So explain what the product is that would be sold to a client. Like dream something up that doesn't exist, but just dream it up.
Yeah, I mean, I could, sure, there's a million types of these products and different ways that institutions kind of, deal with them. But one of the most familiar ones that, I seen kind of getting up there when I was an exotics trader was like an auto callable, right? You have a worst of auto callable, which is, I think, the easiest way to explain this to clients or to people listening is like, imagine you have Tesla, Amazon, and Apple, and let's say it's like, you have a 75% barrier or something. So, a 3-year note, pretty much the contingency on the note is that as long as any one of these names don't drop under 25% of where we are right now, you're going to make 12% a year in yield.
Okay.
Right. So, and then when you think about it to most clients or, most investors, who are non-sophisticated, if you go to them on the street and you're like, hey, do you believe Tesla, Amazon, or Apple are going to drop 25% this year? They're all going to tell you no. So to them, that's a great bet, especially when, you have U.S. Treasury at, 10-year at 1.5 or something like that, right? That people are looking at it and they're like, well, this is a safer bet for better yield. I want to take this. And all you're doing is synthetically just selling the put. Right. So the way how the bank looks to handle this is, or, the institution, I will say, is they're effectively long volatility. So they're long Vago on that note now. And just the same type of matchbook profile that I've been explaining, right? The bank, or sorry, the institution, let me just be clear. The institution will now go into the listed market and say, hey, okay, we're long volatility because of the structured product. So now in the listed market, we're going to go and sell volatility to match the book, right? To make sure that, okay, we're kind of flat. We're flat our Greek exposure. And that becomes a hazard too, right? Because then it goes back into what we were saying that like, this like short volatility dynamic when it's done in such like a systematic way that's like ballooning when it becomes one-sided, that's really a hazard in the market. So this is what I'm saying, that like the risk from the short variance swap sellers, sure, a lot of them got eliminated, but there are a lot of risks got transferred over. It wasn't completely eliminated, and it's in other buckets of the market.
And they don't even realize, I guess, some of the people that they're short volatility.
The people who are long the who are
long
carrying
the structured products, they're getting tricked into selling volatility at too low a price.
Yeah, I mean, I think that's really on their advisor, right? It's up to
yeah. Okay, I'm showing my bias. Generally, though, those things are filled with tons of fees, and I know. Listen, I have buddies who sell them as well. One of the greatest parts of the bank out there in terms of the more complicated and the more difficult it is to price, the more commission there is in it. But I'll leave that for another day. So let's talk about what you guys do, because one of the things you mentioned is you said that all of these microstructures create an environment where it underprices the reality of tail events. So why don't you, I think most people would understand that, but just go over what you're saying when you say that.
Yeah. So, when you think about like a tail event, and I'm trying not to get like super mathematical, but a big thing in this is like looking at the market in some sort of Bayesian way. And what I mean by Bayesian, it means you're thinking about things from a conditional probability standpoint, right? That's like the easiest way to look at it. So you're saying to yourself, okay, for the general consensus here is that this event is not going to occur, right? And the pricing on these contracts, on these derivatives, are extremely low because the market is underpricing this event from occurring. And I believe that if condition A happens, then the likelihood of condition B occurring is significantly higher than what most people are thinking. And I think that's the way how we think about things is like, well, how can we take these sort of bets that will pay out in a really big way if we are right, and offset that by using a couple of other strategies that we've developed over the course of the years as prop traders and just traders in general, to offset that bleed that comes with that. Now, like, I think where we are right now in the market, it's one of those environments that people underestimate the potential for an event like, okay, the market could go down 10% a week, or okay, the market could go down 20% a month. Okay, the market could go down 10% a day, and those are the events that we look to really be there and help our investors, because overall, what we're doing is we're running a strategy that is aiming to generate 200, 300, 400% if you have one of these type of crazy risk off events. And this should be served as a fit for a client's overall portfolio, right? So we'll tell a client, like, look, if you have your equity exposure, right, and 95% of your entire portfolio is in other risk assets, you should look to us to be as a protectionary hedge, right? We are like your quote unquote insurance for a client's portfolio. So if something goes wrong, you could kind of count on us to, our book to kind of step in and have a good return on the fact that equity markets are falling. And I think in this environment, based on all those changes in the market microstructure that I was kind of outlining, I think that leads into an environment where the chances for these outlier events, those anomalies that I was just kind of listing, are significantly higher than other markets that have been around. And I think we're seeing that more and more. Like during November, I think we saw the market drop off of all-time highs and deleverage like 1% in less than an hour. I think recently we just saw that that move on January 23rd when the market kind of had a 5% intraday swing, and people that were looking at the close to close were like, oh, it's not so bad, right? Because they didn't take a look at what the price action that was going on under the hood. So it's like the market is showing us all these events that, like, it's sort of like these little ripples that, hey, it could move really big in short dated time frames, but I think a lot of people are like ignoring it and underpricing the chance of like one of those events actually sticking, right? So like we could see a time where the market drops 10% a day again. We could see a time where the market drops 10% a week, 20% in a month. Those probabilities, based on some of the factors that we're assessing, are significantly higher in this market than a market in 2015 or 2016.
So, Kris, I couldn't agree more. I'm old compared to you, and I listen. I remember when the S&P used to go locked limit down. We haven't had a locked limit down in ages. It used to be that we would have moves that were 5% on a much more regular basis. Even 1999, one of the things that I always like to tell people is that everyone thinks that volatility is always associated with down moves. 1999, go look at the volatility that occurred in an up market. It was huge. But one of the things that I'd love to talk to you about is you mentioned the fact that one of the keys is to not bleed away. And I don't know how much of your secret sauce you're willing to talk about and give away, but isn't that really kind of the difficulty with a long vol strategy is figuring out how to structure get that insurance without having it cost you too much on a regular basis? How much are you willing to kind of talk about how that part of your strategy works?
Yeah, I think I'm definitely willing to speak on this because I think this is what makes what we do so special. Like at the end of the day, if you're running a vol book, or if you're an investor in volatility, you should expect there's going to be some sort of negative drag, right? Especially one that's focused around outlier events. If somebody's giving you something that there is not a negative drag, 9 times out of 10, they're giving you something that's carrying massive belly risk or basis risk or timing risk. And there's some sort of hidden risk that goes on under the hood there. Okay. Right. So there is a dynamic where it's like, as an investor, you have to be sophisticated enough to understand that, hey, if this, return, negative 25 basis points this month, okay, that's okay, because if the market dropped 20%, this could have returned 300%, right? And so thinking about things in that aspect. But in terms of what we do, from a trading standpoint, my partner and I, before like kind of looking at ourselves as like, vol guys or anything, we're traders first, right? So I think him and I both have this like understanding as to how we think about markets and how we think about generating alpha. And, just to kind of put this out there, our partner, who's a co-CIO, he's been an independent trader, with a very good living for almost a decade now, right? So the guy understands how to think about generating alpha, right? At the end of the day, like making money that is non-correlated to the market in a way that is producing pure alpha. And I think we have this understanding where we say, hey, there are a lot of strategies that are out there that we can run from like the old school type of prop style of trading, right? Kind of the way how we learned how to trade from a flow standpoint. We could run that, not take direct, basis risk, not take timing risk, not take correlation risk, and look to be kind of flat on some of these trades, not put up a lot of risk at all. And, really look to offset the bleed that comes with being long volatility, instead of doing something like, okay, I'm going to short front month falls and I'm going to be long back month falls and I'm taking on a bunch of timing risk, or I'm going to short SPX vols and I'm going to be long Coca-Cola vols because it's cheaper, and I'm going to be taking on basis risk between the spread, right? Or like, I'm going to be short at the money vols, and if I'm going to be long a ton of tails in some sort of ratio structure, and if the market doesn't go down far enough, then like, and skew profile doesn't move high enough, then like I'm going to be harmed in the belly, right? We don't like, and to be clear, right, we've seen these things because we've traded in this capacity before. Like, I was a part of a big, exotics desk, right? Like I know what it's like to trade true vol arb and, trade these ways. And I think the way how we look at it is like, if we can do things that are generating alpha, right, that's non-directly correlated to the S&P, that's actually going out there making money, and we're looking to be flat by the end of the day. And the way how we constitute it is running medium frequency type of strategies that are flow based, then we think that that's really an optimal way to do things. And then you see a lot of other tail risk funds and things like that are out there, like Universa, and obviously Nassim Taleb is extremely bright guy, and I respect Mark Spitznagel and everything that Universa has done, and like big ups to them. But I'm just not a believer in doing things that way, right? Like, I'm not a believer in, okay, I got to give you X amount and you're going to bleed out all that money over the course of 3 years, and then that's it. That's just not how I view it. I think tail risk can be ran in an alpha focus, not in a solutions base, and that's what you generally see. It's just like a solutions where it's like, I don't know, man. If somebody was telling me that that's what they were giving me, like, I could code up an algo. Like, anybody could. You could hire somebody to code up an algo that will do that for you, right? Like, doesn't really take much skill to do that. I think the skill comes in the fact that the manager and their ability to understand dislocations, take advantage of very good strategies that are out there, use those strategies to your advantage to mitigate the bleed, and then position for very very strong outlier events when they occur. That's kind of the
So that's fascinating. So you grind out a living, trading the crap out of it while you're to pay for your bleed. Now, one of the things that you've talked a couple of times, I've heard you allude to the fact that the current environment is more dangerous than before. And I think you're talking about more than just this last year in general. I think you're talking about specifically the last month. Am I correct that you're looking at different months and periods as being more prone to having outlier events? And B, do you change your hedges, or not hedges? Do you increase the exposure at periods where you think the chances are higher that it's going to happen?
Yeah, absolutely. And I think that's part of, back to what I was saying, like being a trader, right? Like, you're not just if we have an investor that's with us, right, they're not just investing in some program or something like that, right? You're investing in guys that actually know how to trade vol and like trade the market and understand what the market is telling us. This current environment right now, believe it or not, we've been actually more bullish than I think everybody else. Right?
Bullish on the stock market or bullish on volatility?
No, funny enough, we've been more bullish on the equity market, right? From a positioning standpoint, the way how we look at positioning, there have been times throughout 2021 where the market was very close to all-time highs, and we understood the positioning dynamic, and we were like, this is like, if the market were to drop 5%, the likelihood of it dropping 15 is actually significantly higher because of how positioning was tailored at that point.
Okay.
Right. So it's like, and I know that may have just confused a lot of people, right? But the way how you have to understand it is like, as I was saying, it's not really about where the actual S&P is at that moment. It's about where people are positioned at that moment. A part of that is like, how are their hedges exposed, right? How much margin exposure is out there, right? How active is that being used, right? What are the large institutions? Where are they positioned at right now on certain single names? So I think what you're seeing is actually a healthier flush out and a healthier rotation that's taking place under the hood. I was actually on another podcast and I said this as well, that if you would have told me that large tech would have been deleveraging like this, 1 year ago, and the S&P would only be down 6.5% or so, I would have told you that you were crazy. I would have thought, the market would have been down a little bit more. Vol dispersion traders have been crushing it on the tech side. So I think because of this, the factor that the market has been kind of resilient, soaking in all these things, soaking in the inflationary narrative, soaking in the rate hike narrative, right, and literally digesting it. It's giving us more of a feel to say, hey, the way how positioning is right here, it's probably more of a short term bullish take. right? Now, obviously, this has to be taken with a grain of salt because, positioning changes and these things are dynamic and our views could shift in 2 days, right? We may
Right.
come out, we may see, things start adjusting. But
Can I ask you? Can I interrupt for a second? You mentioned the fact that you said that if someone had told you the carnage that was going to happen in the tech stocks and asked you what the S&P would be down, you would have assumed it was a lot higher. And I was wondering if you have any insights into why that didn't play out. I'd love to hear your thoughts about what occurred that surprised market participants about that not actually causing a more of a severe sell-off in the actual entire market.
I think it was really the fact for the market to have that time to digest why it was doing that, right? And I think what's important, and this is something that I echo when tell our investors all the time, is that it's the exogenous type of events that will be more impactful to this market than the things that the market's able to digest and take in, right? This is why we're looking at the price action and the flows and what's been transpiring recently with the rate hike narrative and the inflationary narrative. And we look at it and we're saying, every day that you get more negative numbers, it's like the market is just like absorbing the blows. Right. And it's able to like slowly grind higher. And we are in a choppy market right now. There's no doubt about it. But the longer the market hangs around, there's more of a structural bid that remains. And that comes from a lot of things like passive investing. It comes from, positional. I could go on and on as to why there's a structural bid in the market. But, I think the bigger picture is the fact that this sell off was just very orderly and it gave the market a chance to kind of digest, why it was selling off, as opposed to like, God forbid there's some sort of exogenous event overnight, right? A shell shock event where everybody has to go risk off. That leads to that liquidity cascade. It leads to that cascade effect because positioning is so one sided, right? It's almost like a house of cards effect where it's like if you shake the room really hard, right, like the cards are all coming down like immediately, right? Whereas like I don't know, maybe if there's a little bump, a little shake or something like that, cards move a little bit, but then the guy who's playing the game can fix it a little bit, right? The more time that you have, it gives the market a chance to digest and absorb the news. And I think with the tech stuff, that's exactly what we've seen. I mean, don't get me wrong, we talked to people on the street and we know there were a couple funds that were getting rid of some stuff, in regards to their tech exposure. But what made this so different is because people were not like throwing the baby out with the bathwater. They were rotating out of tech. And that's the difference. There's a difference between like, I don't want to touch equities at all. And there's a difference between, these growth stocks are up a lot. I'm going to take some off and I'm going to kind of wait. And, I'm going to see what else is out there. And I think, that's the second, the second scenario that I laid out was really what's been going on. It's not, oh my God, I don't want to have anything to do with equities.
So, Kris, one of the words you used was shell shocked, and I thought that was an appropriate word given what's happening in the Ukraine. And I was wondering, as a vol trader, if you could explain to me what's happening in terms of, are people worried about that outcome and therefore buying protection? And could we get into a situation where that has bid up the price of volatility and almost on the news, we could see a price where we actually have volatility sell off and we get a huge Vanna bid that surprises everyone?
Yeah, the longer the headlines play out, the more likely is that scenario. Because again, we're now, we're now absorbing the headlines. People are now adjusting to it, right? Like you're seeing certain headlines come out and people are kind of shrugging it off, right? So it's not going to have that same shell shock impact as it could have had 1 week ago if it just occurred, right? If and by the way, as Vol guys, we don't want that, right? Like there's a moral side of this business as well, where it's like you don't want to see a country invade and people go to war or anything like that, right? So you're never cheering for things like that. But the reality behind how markets will react behind those sorts of things is like if you had an event like that occur 2 weeks ago out of nowhere, that right there is going to just shake the market, because everybody's like, whoa, what is occurring? How are we positioning? We got to get out. We got to reassess, right? And everybody's doing that at the same time. Whereas like now it's giving analysts the time to, kind of digest the numbers, kind of see, okay, what's the actual top to bottom impact of this? Where could this harm our business, right? So if it does occur, it's more so like, yeah, maybe it won't be as impactful. And, from a positioning standpoint, what's surprising though is that you've actually seen a lack of bid and puts over the last like 2 weeks, right? So from a positioning standpoint, two things that we observed was you saw a heavier flow into some of the larger equity funds. You saw a heavier outflow from some of the money markets. You saw larger buying in the ATSs, which are the dark pools. And then you saw a lack of the bid and puts, just outright puts, which was a little bit surprising for us too, because we were just like, we thought people would be more likely to kind of protect themselves in a way, but there's a big but to this that I definitely want to highlight. When you have what transpired in November, December, and January, this lack of bid and put buying is almost expected. And I think when we were looking through this stuff, we kind of forgot that as well. We were just like, we're actually surprised people were just buying less puts. But remember, in November when, the Thanksgiving sell-off was coming, people were not hedged up and they started buying a ton of puts, right? Which led to that very, very strong dynamic between SPX and VIX vols. People were just buying puts outright. And then you had, the market collect itself from December a little bit. And then January, we came right back into this and people started buying puts again because they were scared, right? And then, all throughout February. So now, kind of that, people are kind of like a little bit, I don't know if you want to say sick of it, right? But they've kind of been head faked a couple times. And this is where things could get a little bit slippery, because it's like, as a vol guy, and here's like a key thing, I guess I'm going to like give away. It's like, you don't, like, if you're looking for an event where the market sells off, you don't want people to be buying a bunch of puts. That's almost like a counter signal, like for a tail guy. Like, you want people to like underestimate the chance of some event happening, and you want them not to be bidding vols and buying puts, because that means they're going to be underhedged. And if an event occurs, it's going to be much more impactful. The events where everybody's buying puts, like, it's like a very simple adage, like, markets do not sell off when everybody's hedged.
Right.
And it's more relevant now in this market, which, coming back to the effect that you talk about, right? The Vanna effect, where vols get compressed, and then, deals need to buy back stock, and that keeps a supportive bid in the market. So it's like, if everybody's just buying puts, right, prior to some sort of event, it's different than like everybody being offside and having to buy puts and, not being sure what to do. That's when you kind of get paid as a vol guy, not, vice versa.
And are you scared about that happening here, or are you arguing that everyone owns the puts because they've already bought so much protection in the previous 2 months?
No, so I think, a lot of that exposure has kind of been drying up. And I'm definitely, even though I said, we have more of a bullish view on the market, I'm definitely very, very well aware that if we start to slide down on some sort of negative catalyst, it could definitely get a little bit slippery. Strictly because people are, that lack
Fair enough, because there's the lack of hedging, and there's a lack of put buying, because they got, in essence, what you're saying is that they fool me once in November, fool me twice in January or whatever, and now they're not, they won't get fooled again, as George Bush once said.
Yeah.
By the way, I was laughing when you said, as a vol guy, you're not rooting for bad things to happen, and we know that that's just the bond guys that do that.
That's a good one.
Okay, so listen, I want to talk about a couple of things before we let you go. You mentioned early in the interview, you talked about the market maker games that you were exposed to and stuff. I'd love to just kind of, I'd love to know, any sort of color that you can, provide in terms of market maker games that they play.
Yeah, sure. I mean, I don't want to give away too much, like,
Yeah,
because of course,
just pick an easy one that everyone knows that's not too inside baseball.
yeah, I mean, sometimes you could like, okay, so I'll give this one away because I've spoken to people about it before, and it's like no secret, so some of these things. But like, if you're thinking about like trading the wings, right, and like tails, there's times where guys have their markets like really wide, right?
Okay, yep.
And effectively, they they kind of let the algo trade the tails, right? So they have a very wide market. You could kind of come in and move your bid around and to a point where it starts to trigger an algo. And this is completely legal, by the way, right? Because if you're putting your bid out there, you could honor the bid at that price. But all that you're doing is you're sort of like iceberging and playing around with, where you'd be looking to buy. And what that does is it kind of triggers off the algo in a sense to like, it like awakes the algo so that it kind of senses that this line is starting to get active. I'm noticing bid activity on this line. And then they'll start to tighten up their market, right? So instead of a line being like 5 cents by 30 cents, right? You can have a line that you could get the algo to kind of wake up, and the algo would tighten that line to like 5 cents by like 15 cents or something, right? Specifically in like tails.
It's just moving the quote so you can get the machines to come trade with you. Okay, so why don't you talk about at BMO? I've heard you discuss this before, the difference in trading size. And I'd love to just kind of, when you were at BMO, I'm assuming that's what you learned about risk in terms of, you mentioned in our interview, you said that at BMO you learned about different aspects of risk. Was one of them the difference in terms of trading size versus, so, like when you were, trading with the fellow in the Hamptons, where I'm assuming you could transact on the quote or close to the quote pretty easily?
Yeah, I think, believe it or not, that was a little like trading with Bob, and trading at some of the prop desks that were a little more nerve wracking because that's your kind of like own book. Whereas like if you're at a large bank, you kind of sell like you kind of share a book, right? So it's not to say like this is this person's book. You're kind of under the MD in a sense.
Yep.
Right. And, collectively as a team on the trading desk, you kind of think about things the same way and you kind of maneuver in regards to the bank. But yeah, like some of the size that would go up at large institutions as opposed to like some of the other ones, it's actually kind of crazy to think that, an institution could move markets, right? And this is not specifically speaking on any one institution, right? I'm just talking in general because there's a lot of institutions out there that are much bigger than the ones that I've been a part of. But it's amazing because you think about it and you're just like, how many times were I a trader in this market and I had no idea I was trading against this guy who's filling this huge order, right?
Oh yeah.
You know what I mean?
Oh, for sure. Because the reality is that big order, cascades through the entire vol market.
Yeah, exactly.
Right. And it's not just one. Like I'm a Canadian, and I was trading in the 90s on the desk, and everyone, even though I was trading mostly listed stuff, all of my trades were with the Citibanks and the BTs of the world who had shorted this huge collar to the Toronto Transit Commission. And everyone knew it was this one trade, and this trade permeated through the entire structure because anytime that those guys could buy any gamma, well, they would just grab it. And so they in essence, that trade was seen throughout the entire listed products.
Mm-hmm. Mm-hmm.
And I have to assume that happens all the time. Like we talk about that JP Morgan rule that at the end of the month, that has to be affecting the skew for all sorts of, like, throughout the entire curve, does it not?
Yeah, I don't know about throughout the entire curve, but definitely, that tenor, it definitely is impacted. And I mean, yeah, I mean, I could definitely see guys starting to move their book in a different manner, on days where that thing's coming to print for sure, because it's big size and everybody knows about it at this point too, right? So that's a whole
Yeah.
nother story to kind of dig in. But yeah, you're 100% right. And I think this is, we just spent like a whole hour talking about like toxicity and how the market microstructure is like kind of fragile in a sense. And this is like one of those things, right? You have one huge order to a point where like everybody in the derivatives market, even I mean, there's retail people that know about this,
For
right?
sure. 100%.
So,
Yeah.
it just goes to show you that it's like, when structures like that get so big, like they become more of a hazard than anything. And I think that's important for people to acknowledge. Like markets, man, it comes down to like, I say this all the time, but I feel like nobody gets it. Like markets are like ecosystems where it's like a seesaw effect, that the alpha is in the areas that nobody wants to take them. And that's why that there's alpha there, but like when you have areas that are hoarded because so many people are like thinking they can take alpha from that, those become the best trades to take the opposite side. And like a perfect example is like, like we talk about the short vol stuff in February of 2018, like Volmageddon, right? And how those VIX CTPs, blew up, and, VIX vols kind of blew out. It was because everybody and their mother was like selling vol in some sort of like structured way. And, like the trade was like amazing because it was so one sided that you were getting vols for dirt cheap on the VIX CTPs on anything. And you look back on it now and you're just like, how stupid was that guys were, no, seriously, right? It's like,
No, I know. It's true. It was sub 10, wasn't it? I think it was really dumb. Like it was really low.
Yeah, I mean, it was. I think January of 2020. I remember myself and my partner Will, who was the co-CIO of Ambrus. Like, I got out, and this is what I'm saying. At that time, I was still at BMO, but you just talk to people as traders, right? Just talking as guys, getting a meal together. And I'm just like, man, what the hell? Do you see where VIX is at right now? We were talking just about like just like this, right? We're just like, I can't believe that, vol is actually where it is right now. Long behold, right? Next month comes and, the whole thing blows out. It's like
on nothing too. That was the most amazing part about it. There was no real trigger. It wasn't like there was an exogenous event, a war or something that, a surprise rate hike. It was in essence on almost nothing.
Yeah. The Volmageddon thing definitely, kind of just set it off.
Yeah, I think it forever changed the way that we think about things. The other thing that I would say that really has changed the volatility markets is the right tail experience of when was it 2021 or 2020? No, 2021. These GameStops and all these other things, just to me, that's been it's introduced risk that we never, or at least I never thought existed before. Right?
Yeah, for sure.
I'd love to hear your thoughts about what you think about that. And do you ever think about trying to capture the right tail risk because it might be underpriced?
Yeah. I think one of our like humble brags is the fact that like we were one of the very few vol firms that put up a good number that month because of that dynamic. Because we kind of spotted this, and I know I've spoken about this on a couple of other podcasts and stuff. It was just that we saw that this dislocation in AMC and GMC kept occurring. And it's funny because if you go back far enough, you could see my tweets. Like when GameStop was at like 48, I have tweets out there with pictures on the tweets, right? And it's Twitter, so it's timestamped, right? So I can't just be making this stuff up. But I went out and I tweeted a couple of things about it because I was just like, man, this thing is going. The way how positioning is on this is like it's just looking very bad, and our models kind of picked up on it. And not to say like nobody's model is perfect, right? For sure, like especially ours. It's always a work in progress. But our models picked up on that, and my partner and I was kind of just laughing. We were like, "What is this thing doing, popping up on our screen?" Or like, like get this thing out of here. I'm not going to trade that. And lo and behold, we put up minuscule. When I tell you so little risk, like I think when we're looking back on it, like I don't even think it was like 10, like probably about like 10 basis points of risk, because like, that's outside of what we do, right? It's like very rare that we're like, buying right tail skew in small caps and things like that. So we definitely was just like, sure, the models feels pretty strong about it. Like, I guess, why not just kind of ride with it? And then, man, that thing got crazy.
It
Yeah.
did. It really did. It was just another. It is one of those things where you're gonna you should timestamp it in your mind because it's going to be a long time before that'll exist again. And just awesome. Okay, so listen, Kris, let's get the questions here at the end because I'm looking forward to them. I think you're gonna have some good answers. Let's start with your favorite investment book.
Okay, yeah, I'm gonna be biased here. I know, all the quants that follow me are just going to be so upset, but it is what it is. I'm a very big believer in being partial quant and partial discretionary. I think that, in this day and age, this is the sweet spot. Like, during my younger days, I thought pure quant was the way to go. Like, I learned from a lot of experienced quants that, they would advise me elsewhere. But my personal favorite is actually Reminiscences of a Stock Operator.
Oh,
yeah.
Yeah, listen, you got Patrick. He goes on and on about it. So you're in good company there. How many times do you think you've read it now?
Man, the trading psyches thing is something that we definitely embody heavy at Ambrus. Like, we're definitely like be in a Zen mode, like listen to a lot of trader psyche stuff. So I think I do a lot of audiobooks. It's because I like being the fact that I'm kind of always on the go. Like, if I'm driving somewhere, taking a shower or getting ready to go to sleep, I could do this while multitasking. And I feel like I've went through that like 15 times.
Yeah.
I'm at least, I've definitely read like a lot of other like trading psyche books that like I truly enjoy. And I think I gravitate over to those things, a lot because like once you know the math behind it, right? Like, you don't like, sure, maybe once or twice, you get a refresher on like, okay, how can we try to optimize some of the, fractional Kelly sizing, like how do we think of, power law distributions and pricing tails based on that, right? But it's like, there's only so much you could do with the math, right? It's like the math has its limitations. And I think once you understand the math well enough, you know that it has its limitations. And then you realize, well, the psyche and the discretionary side, like that stuff you could really, really get good at that.
I completely agree, Kris. I always laugh and say everyone thinks that they're battling the markets and they're really battling themselves.
Yes, that's a great saying, man.
Okay, so the next question: are great traders / investors / quants born or made?
That's another tough one too. Yeah, so I'm a firm believer that you can work hard and get good at anything in this world, right? So I'm not saying that you can't be a good trader, right? Because I think that if anybody puts their mind to it and they work hard enough and they're disciplined enough and they fall in love with the game enough, they could be a good trader, right? Which means you could churn out profits consistently, on a year-to-year base and be a good trader. I think great traders are just some people that have a very, very, very special thing inside of them. I think that I've come across a few of them in my lifetime. And I was just shocked with the person's ability to take on that type of risk and be okay with it. And in a smart way, though, right? Because there's a difference between being a great trader and just like, I'm a gambler, right? Like,
right.
Got lucky gamblers, right? So people will constitute lucky gamblers. Lucky gamblers are not great traders, right? But like guys understanding when I'm wrong, I got to size down, right? When I'm right, I will swing for the fences on this. I will, live with the consequences with it, but I'm never putting myself at risk of ruin. Doing things like that, right? Being very well in depth with the market, like, and on the prop side, when you're around guys, you could tell when a guy's just like on, right? Like guys go through periods of like 6 months, a year, even where they're just on, like, red hot. And I feel like I've come across a lot of guys like that. So that are really, really good. But the great ones, I feel like that might be something that you need to be born with.
Okay, well, that's a great answer because it gives hope to all of us, even us that aren't the great traders by naturally. Okay, we got two more for you. The next one is my Byron Ween question. And Byron Ween, we used to talk about his surprises and how he defined a surprise was something that he thought had a less than 1/3 chance of occurring in the next year, but that he felt had a greater than 50% chance of occurring. I figured this one's right up your alley because it's got all sorts of statistics in it. What do you got for us?
I don't think. So this is probably right. Actually, this is probably actually a good case. I actually think greater than 50% chance. I think the market is underpricing the ability for the S&P to close over 5,000 by before June. I think that's
Oh,
actually yeah. I think
okay.
yeah. I think it's actually highly highly likely. We'll see though. But yeah, that's something that I I would bet on, again, because there's just remains a structural bid. I just think that even with the inflationary narrative, the Tina effect is still in play. Nobody's going to shift their mandates from equities into fixed income, and the ball is going to keep going until there's some sort of exogenous event. I don't think it's going to be rate hike implications or an inflationary narrative that kills the market.
I love it. The guy that's hedging the left tail risk takes the right tail bet. I love it. Okay, now the final one, and I think this one's great because, as you say, you didn't go to a target school, which I had no idea what that was, but now I understand. So you've given hope to all the other people out there that are listening that aren't at target schools, and those are the ones that I guess need the help the most. What advice would you give to someone that is interested in getting into our business?
Yeah, I think I'm gonna hit them with the old cliche, right? You really have to love this. I think back in the day, I would hear people tell me all the time, like, "Oh, do something that makes you happy. Do something that makes you happy." And I would always be like, "Yeah, but if I'm rich, I'd be happy." And I think every young kid kind of thinks that way too. But I have a true like love for this game, and I think if people know me by now, they know that like I'm really passionate about what I do. I'm really passionate about trading as a whole. Like you could pay me $3 million more, to go play in the NBA, and I wouldn't do it just because I just really enjoy, being able to use my mind in a statistical way to lay down bets on this and think about things in that manner, as opposed to any other job. Like I don't. This is the most fun game for me, and I take it very seriously. So I would say for people who are looking to get into this business, if you feel the same way, that it's like you have a burning desire for this, where you're just like I this is it for me. um I would say make sure you pursue it with all that you have, because you don't want to be 35, 40 years old and kind of look back and be like, shoot, I didn't really do something that made me happy and I'm kind of miserable. I see a lot of people that, and that's why you're seeing a lot of people who are like millennials kind of, quit their job to become like social media stars and things like that, because inside people are just like not happy, and they're doing stuff that doesn't make them happy. So if you really want to be in this business, I would say make sure you really want to be in this business, because you're going to eat it on the chin, to start. And those rookie years of you eating it on the chin, you have to really love it, because if you don't love it, you're just not going to follow through with it.
Kris, that's such a great answer. And I can tell you that after listening to you on different shows, following you on Twitter, you are obviously someone who is passionate about the game. It comes through in everything you do. You're a real pleasure to have on our show. It's been terrific to have you to talk about your experiences and everything. Why don't you tell people a little bit more about where they can find more about you and your firm?
Yeah, so I'm on Twitter, so I'm at KSIDIII. If you just type in Kris Sidial, you could find me on Twitter. I'm also on LinkedIn. And if you guys want to find out a little bit more about myself and all the other guys at Ambrus who are much smarter than I am, go to www.theambrusgroup.com. I'm sure you guys could reach out from there. We'd love to hear from you guys.
Kris, it's been a real pleasure getting to know you, and I look forward to the next time you're in Toronto, which will probably be the summer because you're obviously smart enough to avoid us in the winter, of getting together for some beers.
Absolutely, man. I would love to meet up with you, and I appreciate you having me on the show.
Well, thanks again. Thanks for your time.
Appreciate it, man.
All right, Patrick, it's time for Talking Charts. What do you have for us?
Well, we're going to talk some charts, but let's quickly go through the things we were watching last week. Number three was the commodity breakout or fake out. And it's kind of a mixed bag because we'll talk about gold in a moment, but energy did really kind of peter out. Oil made that peak when we were recording last week with that big jump on the geopolitical escalations, and it spent much of the day or the week consolidating, right? Even copper gave back the initial pop and is giving some back. So, overall, while not every commodity has pulled back, it really was a stall out. It didn't keep continuing. Any comment on that?
No, it makes sense though, because we called for either one of them and we got neither. Okay.
All right.
Number two.
So number two was the slew of Fed speakers. Did you take anything away from that?
What was interesting, Patrick, was it's very divided. We had a few, Mary Daly, I think, came out really dovish early. Then we had Bullard doubling down, but kind of sheepishly. And then we've had it's been a wide range. I don't think they know what they want yet. I though do believe that on the whole, the Fed is busy talking Bullard's stupid comments down, and that at the margin we've gone the other way. And I think that's evident by the fact that for a while there we were pricing in a 50 basis point hike March, and I believe it's now tilted back to a 25.
Right. All right. So, and the number one thing we were watching was asking, does Putin go in next weekend? Well, boy, is it just a lot of talk and a lot of confusion and nothing really happening. And what's your take on how this is all playing?
He's just being a dick. Like that's it. Like, I think he's just trying to, make everyone as mad as possible. And I don't know. I still think, Patrick, if you made, gun to my head, what's going to happen? He's going to go in some way, but I don't think that we're going to have a full scale Ukrainian invasion. I think that he's just going to grab some territory somewhere and just, call it a day.
I don't even know if that will happen. Like,
you don't think?
Well, no, look, I'm sort of in that opinion where this is all about getting to the negotiation table. You first need things to get really messy. And everyone realized that we're at the brink, that 11th hour, and everyone says, well, shit, we got to de-escalate right now, and everyone's got to make concessions. And I think that this is a game of like a bunch of gorillas beating their chests just to see who's tougher. And then it's going to come to a de-escalation point as they negotiate it back. I mean, there's no winners if they go into a shooting war. And so I think that this is just a positioning for negotiations.
Yeah, you're probably correct. I think he's going to do that. I think that there's a chance, and I think it's higher than, it's like 30% chance he goes in and 70% chance that you're correct. By the way, I was just laughing because remember Brent Donnelly?
Yeah.
We had him on our show, and he has this great line. He says that if you want to, you can always call for something being a 40% chance. And his joke about calling about something over 40% chance is that you're not actually predicting that it's going to happen because it's only 40%. It's less than 50-50, but you can sound smart. And so he always, when you see him on Twitter predicting something with a 40% chance, it's basically that.
40% chance that he goes in.
You know what? I just blew it. It's not Brent. It's Dario Perkins that did that. I'm mixing up our guests.
Oh,
you can edit that out, or
no, you messed it up. Let everyone know. All right, so number three for things to watch this week, and the one thing I really wanted to watch was, does the equity weakness continue into next week? We have a shortened week with President's Day, and so a holiday coming in, but overall. The geopolitics have been swinging the markets, but let's be realistic. The overall price action has been shit. The breadth of the market has been horrible, and every rally's been failing The selling is persistent, and so there's no sign that the bulls are regaining control of this market. The bigger question: does this result in another full downdraft lower? Does it continue next week? So we can observe the way the price behaved, but does this now lead to another round of weakness? Right now, the deterioration below 43.50, where this previous low is I think is a technical blow. It's just a lower lows, lower highs, selling. It's now the probability of a double bottom retest along these 4,200 low, and even a breakdown to 4,000 or lower is entirely possible. Just like you look at the NASDAQ breaking down back down to these lows. I mean, all you need is, it's at the edge of a cliff. All you need is one little push, and this thing is dropping to 13,000. The other thing, Kev, I wanted to touch on was the Russell. And while the Russell held up a little bit better, it's still a pretty ugly chart, and it's slowly starting to creep. The question I have, what if the Russell has already done a lot of its correction? What if this is not where the next ugly leg occurs? It'll be interesting to see at this stage whether or not the Russell, let's say, actually on a relative basis, isn't going to be as beaten up as the major indices. One way or another, we are going into next week with nothing positive about the price action. Maybe a news catalyst appears over the weekend. Maybe it's a geopolitical de-escalation or something that causes a stock market turn, but there's no evidence of that right now. And so the question of number 3 was, does that weakness continue? Well, there's certainly no reason to believe it's not. Any comment on that?
No, I love it. Lots of good stuff there.
All right, so number 2 is the bond carnage over. And what I thought was interesting about this was after just a bloodbath. I'm just going to use the 10-year future as opposed to the yields chart. The 10-year bond has just been murdered to the downside for the last 2-3 months. You look at that 5-year, you look at the 2-year bond. Just look at that. That's like, isn't that ugly?
Yeah. It's
so ugly.
It's shocking.
But the last 2-3 days, it's bouncing. Is this just a pathetic dead cat bounce that is going to last no more than a week and the whole thing's going to roll over and continue? Or have we seen a meaningful a short-term oversold state that is going to start to establish the floor of where these bond carnage ends? I think it's so premature to make that call, but at least it's turned off. So it's now at least a short-term technical reference point that we can hang on to kind of stress test whether or not the bulls can actually put something together off of those lows. Interesting that when you look like investment grade bonds, hasn't this been one of the ugliest drops? Like, because now investment grade not only has been hammered by general yields rising, but credit spreads finally started to get a little bit of stress. And so, like, look at this drop. Like, if this was the stock market, people would be shitting themselves, and nobody's even noticing.
It's true that the credit market has had the worst start in many, many years. It's shocking.
Yeah.
Well, it's not really.
Yeah.
Some of us have been.
Some of you have been bearish. Yeah, for like 3 years. Like, yeah, that doesn't make
3.
you
It's
early.
probably been 15. But anyways, who's counting?
But the junk bonds stopped going down all week after putting a short-term low. The point I'm making is that it's been very ugly. But almost every very ugly oversold state of a market has a reaction at some point. The question is this now oversold enough where we're going to see bonds have a reflexive snapback rally? It's 100% what I'm watching next week. What do you think?
And it is obviously something I'm watching very carefully too. And to me, it's all about the yield curve, about which one moves. And my kind of feeling is that you might be right on the 2s and the front end, and you might be wrong on the long end. But that's just kind of
so. That's just
talk in my book.
But you know what? That to me, that's That's the bond carnage not being over then, because the way I look at it is that when this bleeding that's occurring gets so oversold, you should see pretty distinct rise in bonds as yields back off of their highs. And I don't think it's just going to be on a segment of the curve. If it's on a segment of the curve, I don't think that actually counts as an oversold rally.
Okay, well, then I don't think the bond carnage is over.
All right, so let's talk about number one. Not to Gucci it, but no, actually, we're not. I rephrased it in a way to not Gucci it. Are we witnessing a gold prairie dog?
Oh yeah, it could be.
Yeah, it's it could be, right. Like it's so now it has not beat the May high, but it after an extended trading form sideways trading consolidation, it has now beat that November high, and we're obviously back to 1900 now. We know that we don't want to gooch anything or say anything unnecessarily.
People are getting mad at us, though, because all we do is say we're not going to talk about it. And they want us to talk about it.
But the question is does a prairie dog? Do we next week see this thing throw right back into the trade range below 1875? Now, even a natural Fibonacci retracement could get back to 1850, 1875. But the bigger question is, will the bulls be buying dips? If there's a 1 day 40-point drop on gold is nothing if then following 3 days the bulls buy it and bring it right back. And what we want to see is the characteristic of bullishness as to whether or not old dips are being bought and whether it's holding. And so will it be a prairie dog? I think is a really interesting thing to watch for next week when it's trading.
Here's my sense about gold if we're going to talk about it. I think that the late December weakness was caused by the Central Bank of Turkey selling, and that I think that this recent uptick might be attributable to the Russian Central Bank buying, but also gold has become the true geopolitical hedge that we've seen this week.
But does that make you nervous? Because what if the negotiations de-escalate everything in the middle of next week? Does that like hammer gold to the downside?
I'm worried it might, because I look at gold and it seemed to be reacting on the headlines much more than oil. And oil earlier last week or earlier this week was moving with the headlines, and it seems like it's. I guess too much.
But I'll tell. Let me put it another way. What if that is absolutely the most important test right there? Imagine for a scenario that there is a massive de-escalation, and gold's first reaction should be to the downside. So let's say everything comes to some solution and everything de-escalates, and gold goes whipping $50 to the downside in a day. Just like it just completely hammers. If the bulls buy the dip, it tells you that this thing has really started a new bull trend and then work its way after the reaction. Like think of what happened here just 3 weeks ago when that big drop happened from 1850 down to 1800. It was like a $60 drop in oil in 2 days, gold in 2 days. And immediately the bulls started buying the dip. The question here is that same characteristic emerge in the de-escalation? Absolutely, I think you're right that the first reaction will be gold getting hit. That's just the normal response mechanism. But the question is what the traders do on that dip will be the real tell, wouldn't it?
Yeah, I couldn't disagree more, but it depends on why it's going up, though. And if I'm right about it being geopolitical, who knows? I was keen as well that I thought the gold was going to bottom on the day of the first hike, or around the first hike, and so far I've been dead wrong. And I did worry. I said to myself, "What if everyone's looking at the same thing, and gold's going to run ahead of it?"
Yeah,
and that seems to be what's happening. But I'm having trouble deciding how much of it is geopolitics.
There you go. Anyway, that's it for talking charts, Kev. So let's go on. Skin in the game, buddy. Yeah, clip me.
I got you.
You got me.
It's nice
but you know what?
Win-win.
But let's get straight. Okay, so we did Apple. over under 168.64 where it was closing, and I tell you, I was looking good. Pretty much right up until yesterday.
It was a well-priced trade.
You know, like it got the good reaction that I expected, and then just today's little carnage. Like, I mean, at one point today, I was actually up. I actually had a chance of winning, and then the selling actually kicked in at the tail end of the day. So it was well priced. You deserved it.
Took me a lot to sell it down.
Yeah,
took a lot of stock for me to sell it down.
Like,
so
you know what, you got your pitcher of beer. So congratulations,
exactly.
buddy.
All right. Skin in the Game is our weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants. Every wager needs to settle by the next episode, and the currency for the wagers is as follows: a Duke and Duke, pint of beer, burger bet, pitcher, case of beer, 2-4, bottle of wine, and a steak dinner. The winner of the bet is obligated to create a new bet for the following week, and all wagers settle and fold, and there will be no netting of positions. Okay, so that means me.
Yeah,
I'm going to do gold.
Now, you're
one,
basically saying Putin decides whether one of us gets a steak.
And I'm going to do
the
the one touch because I think one touches are more fun. They're more exciting.
Yeah, all right. Well,
we're only that the one touches you can lose them like on Sunday night.
Yeah.
Right. Like we've had one touches that you lost.
Yeah, it was over in 4 hours.
Yeah. So. Okay, so are we gonna stick? We got to make sure we got the right contract. This is
this is continuous, but
you got to use a proper one so that we know.
Yeah. No. So okay, we're gonna use you want the Feb or the Marches?
No, I think that isn't in gold. I think it's April is the one that everyone trades.
All right, so we're going April's. All right. Yeah, there you go. No, that's fine. Well, we just need a good contract.
I don't know because they don't. I think gold trades. I think February does trade the most, but then I think what happens is it doesn't go into March; it goes into April for some reason.
Anyway,
okay.
April is trading at 1900.
So what I want to know
.8.
Okay, so basically 1900. Okay, so we're gonna do a one touch. Can you tell me what the low was on that red candle midweek?
That was 1845.
That was the low?
Yeah.
Okay. Here you go. I'm gonna I feel like that's not enough. $18.41 one touch. Do you want it or not?
I'm taking the over.
You're taking the won't touch it?
It won't touch it.
Okay.
So this is a Putin play. So is there a de-escalation or not? What's the bet, buddy? I'm gonna fuck it. I'm going case of beer.
Okay, you're on.
Case of beer. All right. And it's got to be a good one. Oh no, or Sank.
Yeah, the bet sank on. You're gonna get him. Look, because I got extras.
All right. Okay. The bet is on. All right. So time for no stupid questions, and Lena, save us from all of this stupidity. All right. We got a couple questions we wanted to cover.
Starts with a gold one.
Yeah. Hey guys, I've been watching the gold space for the last couple of years, but I don't know that I fully understand the relationship between gold, silver, miners, and junior miners. I'm not exactly sure what my question is here, but I would just love to hear your breakdown of these relationships. If gold has a big blast off to the upside in the coming weeks and months, what else could we expect to see within the precious metal space? I fully understand how careful you will need to be in the wording of your response as to not gooch or anything.
He understands.
He understands.
Okay, you want to start or you
well,
want
I'm going to start and then you can fill in the blanks. But the first thing that you want to always recognize is that gold plays a very important part to the sentiment of the other metals. So when we're looking at flows into precious metals, the movement of gold is influencing it. So like silver, which is a cousin of gold, it's hard for silver to be down when gold is up. While I mean any short-term little intraday moves that are wiggling around, but when there's any meaningful move, they tend to be correlated. And that also tends to then spill over to stocks, where even though the fundamentals in many of these gold miners don't it doesn't matter whether there's a $30 swing in gold. They've often forward sold their gold production, and they've already sorted things out that a fluctuation of gold higher or lower doesn't really fundamentally change the company, but it does change when a lot of traders are turn to the miners as their way to allocate to a bullish outlook on gold and silver. And so there's one strong correlation in all of it, but it is not like a hard and fast rule where one is guaranteed to go higher or lower when another one is moving. How would you say that is?
I think that I would just I agree with all that. I would say that I'd just give a little history lesson. In what was it in the 20s? The American president outlawed gold, so you weren't allowed to own gold, and for a long time there was no owning of gold, and so therefore gold miners were one of the ways that people could own and get exposure to that. And even when gold was allowed to be owned, there was no easy way to do it. It was difficult to own physical gold. And so gold miners for the longest time traded at huge premiums to their other mining companies, let's say.
Yeah.
And because that was in essence a premium bid because they wanted exposure to what was viewed as an inflation protector. Then the ETF came along, the gold ETF, the GLD, and that changed the whole ball game. And during that period, gold miners, that premium got systematically reduced and reduced and reduced and reduced. So to the point where now I would argue that the gold miners are cheap, and that you should see a situation where they actually might outperform the gold because they've just been neglected for so long. Having said that, in terms of the gold versus the silver, silver is generally considered the higher beta one. So in a real gold bull market, it is generally accepted that silver will outperform. But that is, as Patrick says, a general rule, and anything can happen. There can be times when gold outperforms silver, but just kind of on the back of the napkin, what people usually expect. They expect in a real bull market to silver out to perform. The other question about the junior miners, in a real good bull market, generally the junior miners would outperform the senior miners because they have more leverage.
Yeah.
So that would hopefully explain the relationships between them.
Perfect. All right. Lena, the next question.
The next question here. Thanks for a great show. I'm looking forward to trying last week's cookie beer. I'm listening to old episodes, and you guys were talking about Eurodollar futures in December 2018. Are you still trading Eurodollar futures? Is it worth it with the transition to the SOFR alternative? My broker does not offer SOFR futures yet, but I would love to trade them, and I am curious about your take. Thanks.
So yes, I am. It's Kevin here, and I trade these all the time. Obviously, yes, there is a transition going to the SOFR, but Eurodollar futures are still plenty liquid, and there's really no concern about that. And
I have to agree with that. And the other thing is, one has to really step back and realize that ultimately, whichever one you're trading, it's a tactical or strategic positioning on direction of interest rates. And it's not like one is going to move and the other isn't. Yeah, there's different mechanisms behind how interest rates are determined and settled and all those different things. But ultimately, when one goes into these markets, you're making a direct call as to which direction interest rates are going, right?
Yeah. And listen, there's going to be liquid markets between the two of them for a long time with spread markets. So there's nothing to be concerned about. If you want to go and trade the short-term interest rates, this is the way to do it. And I would, if you're at all interested, go ahead. It's great. And I would contend that recently, this past 3 months, maybe 6 months, has been some of the best short-term trading opportunities in this market that we've seen in years.
Right.
It's terrific. There's some great things happening. Go make sure you check out the options, and make sure you check out mid-curve options. That's much more. It's complicated, but it's worth the hassle.
There you go, Lena. If anyone else has got questions, where can they submit them?
So if you have any questions for Kevin and Patrick, please submit your questions to nostupidquestions@markethuddle.com.
Fantastic. All right, Kev.
So thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give Lena a follow there on Twitter at the Market Huddle. And you can listen to the Market Huddle on all the networks. You know them all. And please rate and review us on iTunes. Patrick, where can they find you?
You can find me on Twitter at Patrick Ceresna, or you can follow me at the bigpicturetrading.com. I almost forgot I'm not drunk. No. Anyway, Kev, where can they find you?
I'm on Twitter at Kevin Muir, or you can check out my newsletter at themacrotourist.com. And listen, we can never have too many friends. Bear market, bull market, we're just happy to spend some time together on this crazy ride. Though, thanks for tuning in. Now stick around for an abbreviated after show.
There you go. All right.
So are you going to rate this beer?
I will. You know
Patrick,
what?
just so everyone knows,
the
after show is going to be tight because Patrick wants to go out and drink more.
Well, okay. In fairness, it is 11:30, and I have to say this was not my first drink of the evening. And but
Patrick, you're a real slacker. You barely work. It's not like you do another podcast and have businesses or anything.
No.
You're a slacker. Let's just face it.
This is my dedication. Who on a Friday night, 11:30 is recording a podcast? Only losers like me.
Yeah.
Like this is.
Because you go, I can drink during
that's
the
true.
podcast.
Well, that's why we did this.
This is
Eric
why.
Eric wouldn't let him drink, and we were like, okay, I'm going to let you drink. All right, let's go. Give us your review so you can go.
No, you know what? I'm going to give it this a 7.9. You know what? There's New England IPAs. There's a bunch out there. There's a lot of good ones. This is definitely a good one to drink, but I don't want to give it too high of a score where somehow it blew my mind. You know what? I would say to anyone who has an opportunity to order this, fantastic. It's worth ordering, but I just don't want to go over the top on the scoring of this. Anyway, that's all I've got.
All right. So we'll let him. We'll cut it off there and let the poor guy go out and have some fun. We'll catch you next week. We'll make a longer one next week.
He's got to go clubbing.
That's right. Can you imagine Patrick clubbing?
No, we don't want to imagine this at all.
You should go talk to Morris about getting some low-cut silk or satin shirts.
Oh my god.
He loves the low cut or the bathrobe. You know what you could do? You could get a inside baseball with a little chestnut bathrobe and take it to clubbing.
I love it.
Okay.
All right.
Have a great weekend.
Hey, have a good one, everyone. Cheers.